Ever felt that gut punch when a crypto token you hold suddenly dumps? Was it a whale, FUD, or something far more predictable, like a token unlock? For investors in Newton Protocol, $NEWT, understanding these scheduled supply releases isn't just useful, it's crucial for navigating the token's history of extreme volatility. Today, we're breaking down how $NEWT's past unlocks have shaken its price and what that tells us about its future. The initial shock, airdrops, and exchange listings. Newton Protocol's journey began with a bang, and its initial token release set the stage for volatility. A massive early supply release often creates the most intense pressure, and for Newt, that came with its major exchange listings. Specifically, its debut on a top-tier exchange in June 2025 saw a massive 40% plus price pump, but this was immediately followed by a steep 44% correction days later. What caused that massive swing? It wasn't a traditional token unlock in the form of a vesting cliff, but rather the initial release of tokens to airdrop recipients. These recipients, getting their tokens for free, had a high incentive to sell immediately and take profits, effectively acting like a large, sudden unlock and causing a short-term crash. This event demonstrated the market's sensitivity to even temporary supply surges. The tokenomics foundation, linear vesting. To understand the ongoing impact, we need to look at Newton's tokenomics. Unlike tokens that have huge, quarterly cliff unlocks that can shock the market, a significant portion of Newt's non-circulating supply is structured with a more gradual approach. Newton's strategy includes a linear unlock mechanism over 48 months for parts of the supply, such as the on-chain foundation treasury. This linear release distributes tokens gradually, typically smoothing out the supply shock over time. The goal of this structure is to provide more predictable supply and better market absorption, ideally leading to greater price stability over the long run compared to projects with sudden cliffs. However, certain allocations, like those for early backers, include a 12-month cliff followed by linear vesting. A cliff means no tokens are released for the first year, after which a substantial portion, sometimes as much as a 33% unlock, hits the market at once. These cliff events represent major points of risk, where high selling pressure from early investors could cause another significant price dip. Volatility in context, the bigger picture. It's important to remember that token unlocks never happen in a vacuum. Newton's price movements are also heavily influenced by its sector and major news. The period immediately following its initial listings, which were marked by sell-offs, also saw high volume-to-market cap ratios, signaling extreme speculation. The subsequent price action has been a roller coaster, falling over 67% in the year leading up to October 2025 from its all-time high, with sharp monthly drops of over 20% in some periods. While new exchange listings, like the one on Indodex, provide a short-term bullish boost by increasing liquidity, the market often uses these highs as an opportunity for more profit-taking. The bottom line for Newt is that its major initial volatility was driven by an airdrop-fueled sell-off. Moving forward, its price will continue to react to the scheduled cliff unlocks for early backers and the ongoing linear releases. These events, especially the large cliff unlocks, will serve as moments of maximum sell pressure, and every investor should mark them on their calendar. Understanding these supply dynamics is the key to trading Newton Protocol.